Hello, everyone. Thank you so very much for joining us today. My name is Randy Wostratzky, Director here at the Spectrem Group, and I'm happy to be joined by Spectrem's Managing Director, McBreen. Today, we're going to talk about the latest Spectrem Investor Confidence Index that was fielded back in February, as well as go through a couple of slides from our recently published report, The Legacy, How Investors Are Impacted by Inheritance, and then finish it up with a quick review of our High Net Worth Insights newsletter. Starting things off will be Kathy with the Spectrem Investor Indices highlights from February. Kathy, take it away.
Hi, everyone. Just a refresher for those of you who may not be familiar with our Investor Confidence Index. We've been doing this index since around 2004, and every month we go out to the field and we ask investors how they're feeling about basically the economy in general, about their own investments, what's impacting their investments, etc. What we then do is we've developed a confidence index so we can tell you over the course of time if people are more or less concerned about their investments or more likely to invest or not invest. As you can see, we do two different segments. We do those with over $1 million of investable assets, and then the Spectrem Affluent Investor Confidence Index are those with over $500,000 of investable assets. As you can see, in January of this year, the confidence index was up to an 18, up 3 points compared, actually February I meant, it's at an 18, up 3 points from January. Compared to a year ago, it's up 8 points. But if you look back, the highest Investor Millionaire Confidence Index was a 25 back in 2004. Similarly, the Spectrem Affluent Investor Confidence Index was at a 12 this month. That's up 3 points from last month and 5 points from last year. And similarly, like I said before, 2004 was the high for that particular index. So we were all really happy in 2004. I don't know exactly what was going on back then, but there was a point where we always thought that our index only went up or only stayed high until 2008, and then that all changed. As you can see here on this page, if you look down, you can see 2008 and 2009 when the index was at its lowest points, and we've basically been trending back upwards and are getting back close to where we were at the beginning of the index back in 2004. The chart at the top of the page as opposed to the bottom of the page really just tracks the last year. And as you can see, the last year hasn't spiraled upward, but it was up, and it's continuing to trend up slightly upward as the time goes by. So I wanted to take a look here at the Affluent Household Outlook. The Outlook is one of the components that we look at to see to compile the overall index. And as you can see, February is at 29.9. This is lower than a month ago. A month ago, when we were talking to investors were really worried that the market was like too high. But they were feeling good about everything, but they were concerned. And now I think that now that there's been sort of a readjustment of the market that continues to happen every day, I think that they've stepped back a little more worried about their household than they were before. Again, look up in the right-hand corner. Back in 2004, we were at a 46.1, but the lowest household outlook was in 2009 at a negative 33.8. So 29.9 actually is still kind of a very positive, sort of semi-bullish outlook. When we look at the components of the household outlook, you can tell exactly what goes into it. We look at their overall household outlook, we look at the household income, the outlook on the economy, the company health, and household assets. As you can see, all those in the green are those that are up, but the change from January are the ones that are down. So you can see just down 10 points from January 2018 in the overall household outlook, as we saw before. And another down thing was the outlook on the economy from January to February. Company health was looked down on, as well as household assets. Now again, if you keep in mind, a lot of this was in the field when some of the most volatile moments of the Dow were happening. Not that it's terribly smoothed out at the moment, but it's definitely a little calmer this week than it was a few weeks ago. What is the story in the news most affecting your economic outlook? As you can see, the political environment on the left is just below the stock market conditions, and it's not surprising that stock market conditions at the moment is trending the highest. Now, the thing that will jump out at you, I know, is if you look at the political environment answers at the 83%. Well, that was in November of 16, so that was right after the election. So it makes sense that that was sort of an interesting time period. But right now, stock market conditions are worrying everyone, followed by the political environment. Now, if you look at it versus retired versus not retired, we tend to like to look at this. And as you can see, this month there aren't very many changes. At different times, we'll see bigger differences. Like when taxes were a hotter topic, there was a lot more difference of opinion between those who were retired and not retired. But this month, if you really look, everything's pretty much the same. Whether you're retired or not, you kind of feel similarly about these conditions. Also, affluent people versus millionaires, there's not a lot of differences in their opinions regarding this topic at this particular time. When we ask people what is it they're likely to invest in at this particular time, the current month, you can see stock mutual funds, stocks, they're still much more interesting. Bonds are starting to go up just a little bit. They were much higher in April of 2009, which was a long time ago, and people were worried about security. But if you look at the February 2018 versus the January, even now, because of what's happening in the markets and sort of this leveling off in the interest rate environment, people are starting to look more at bonds than they have in the past. Again, a similar amount of cash people are keeping around. Bond mutual funds, not really changing at all. Okay, so Randy is going to talk to you a little bit about some research that we just completed with inheritors.
Thank you very much, Kathy. Just a little bit of a background here on this particular report. Please keep in mind, at Spectrum, we are in the field every single month to complete the indice data that drives all of the things that Kathy just went over right now. We do have a variety of other tools where we are in the field every month with investors who have anywhere from $100,000 to $25 million in net worth, not including their primary residence, driven by a new technology solution that we've just been rolling out to our clients here over the past couple of months called Spectrum's Visual Analytics. But what we're going to be talking about today is a specific report that we went out and fielded some questions about relative to inheritors and the inheritance that they've received. So just a bit of a background relative to the methodology. The survey was fielded between August and December of 2018. This was an online survey done with a panel that reflects the affluent population widespread across the United States. Respondents had to qualify with a minimum net worth, not including their primary residence, of $100,000 or more, as well as had to have received an inheritance of at least $100,000 in the past. One of the things that you can see here that I think is quite striking relative to the data is the amount of respondents that we had in the 56 and up range. Most of our inheritors were over the age of 50, and as such, we had a significant amount of these investors that were either retired or semi-retired. One of the things that we've been emphasizing to our clients relative to the wealth transfer concept right now is that it is not just that the baby boomers will be giving their money in the upcoming years to those in Generation X and the millennials, but there still are a lot of baby boomers that are out there right now whose parents are alive and well, and who maybe have begun to start to divest some of their money to their children who are baby boomers. Remember, born between 46 and 64, so we're still looking at 54, 55 years of age for the youngest baby boomers. When talking about whether or not it was an expectation or surprise, it's certainly visible here that the oldest group of respondents was the most well-versed relative to the inheritance that they were going to get. That's something we see in quite a bit of our research. As age increases, so does the level of involvement that these individuals have and these households have with the management and the know-how of everything that's going on relative to their financial blueprint. As far as the levels of inheritance, you can see here a majority were in the 100K to 500,000 range, with just over 10% in the 500K to a million and the 1 million plus range. Although that is something that is certainly skewed towards the lower level of inheritance, even $100,000 or $200,000 in inheritance is a significant amount of money to those who maybe only have that amount right now in their net worth. And so talking about the types of inheritance that has been passed along, 3/4 of it was done so via liquid assets, so you can see their cash, stocks, bonds, and things like that. There is also a quarter of illiquid assets that are passed along, mainly driven by private residences. You still see there are some other areas there, like farmland and collectibles, that are over 10%, but a strong majority is a private residence that has been passed along relative to various illiquid assets that these inheritors have received. Something that's very striking here when talking about advisor usage is that, one, there's been throughout the years a trend towards more and more individuals in the lower, and by lower I'll call that maybe $100,000 to $250,000 or $300,000 in net worth, being self-directed, not really using a financial that much. And here you see that's at 37%, so almost 40% with no advisor usage at all that have received an inheritance. You do have 44% there that had been already using an advisor and keeping it there. And then surprisingly enough, I thought the 12% number of those that said they began using an advisor once they received their inheritance, where previously they had not been using one, that shows a lot of potential for an underserved market. There's a couple striking things about what these folks did with their money. The lowest net worth coinciding with the commensurate lower level of inheritance, you can see represented by the red. So the net worth between 100K to $1 million, and then the inheritance a little bit less than that. And those folks really spent a lot more on themselves via personal spending and vacation, as well as on debt servicing. As opposed to, you can really see there's a difference in the net worth of greater than $1 million who have inherited 500K to $1 million or $1 million plus that have either upgraded their home or decided to really save as much as they could for their children or grandchildren. Across the board, it is a positive issue, and let me point out as well, these answers are not mutually exclusive. We asked the respondents to mark down all that are applicable relative to their situation, and with the exception of those represented by the red line there, everyone over, 3/4 of all the other respondents were investing part of that inheritance in some way. So that's always a good sign to know that folks are out there and being active with their money. Just a quick reminder that information like you just saw today is presented in a number of different formats, either via some of our larger in-depth reports or in our High Net Worth Insights newsletter, where we create custom content and write original articles every single month that highlight not only the proprietary investor indices, but also our most recent research reports. There are individual subscriptions available. There are corporate enterprise-wide subscriptions that are available, and a number of different ways that this impactful content can be utilized. So please do not hesitate to reach out to Catherine or myself if there's anything at all that we can do to be of service to you or your firm at this time. Kathy, anything else you'd like to add before we close up?
No, I'm good. Thanks, Randy.
Thank you so much for everyone again who has joined us for this webinar, and we look forward to being in touch with you soon. Thank you.